Today we will look into why statistically small caps tend to yield higher by analyzing the stock of AAR Corporation. It was the year 1951 when Alan Eichner founded a company, which was renamed 11 years later to today's name Allen Aircraft Radio, or short AAR. AAR started supplying radios and other aviation equipment and started its aviation maintenance sector in the 1970s. Their main business model is, for instance, landing gear overhaul, engineering services, or wheel and brakes. Besides services, they also sell appropriate replacement parts for airplanes. So AAR buys old or spare items, or even complete decommissioned airplanes which couldn't be repaired or are too expensive to repair. Afterwards, they take the airplane apart and reuse its spare parts for other still operating airplanes of the same type. After 2020's pandemic shock, the aviation sector is flying from one record to another, with airlines reactivating the A380. Of course, some stocks tanking lately, like Boeing, but all in all, these issues are company-made and not from within the whole aviation industry. Unfortunately, AAR is not supporting the A380. Instead, they are more focusing on the more commercial successful airplanes like the A320 for short-haul or the A350 for long-haul flights. So with the high demand for post-corona travel activity, AAR has great momentum. Speaking of momentum is one important factor in the finance theory. Today we want to have a look into the question why small caps yield higher, or at least in the long run. First, we need to ask, what does small cap even mean? How much is still small enough? Let's have a look into the two most prominent indices like Russell 2000 and the S&P 600, which contains just companies with a market cap from around 200 million up to 10 billion US dollars. But why should these companies tend to yield higher? Well, the smaller the company, the higher its risk not to sustain in the market, since its market dominance is not in such a pole position as when you're a large cap. The risk of failing tend to be higher for small caps. There must be a premium for this, and this is the higher yield. The factor was scientifically proven by the so-called Fama-French three-factor model, which includes three factors: quality, value, and size. Now you might ask, why not go all in small caps? Well, where risk is also longer downturns and you need longevity to persevere. When analyzing just the past 10 years, you'll clearly see that since 2019, large caps tend to outperform small and mid caps. So the size factor is not like a physical law, instead it's more like a multiple decade statistical proven trend. It makes sense to diversify a portfolio and reduce big cluster risks. Small cap indices tend to be more equally diversified in contrast to the S&P 500, because the top 10 positions represent over 34% of the whole index, whereas the top 10 positions represent just 6% of the S&P 400 mid cap and S&P 600 small cap. This means the small and mid caps indices are way more equally weighted than the large cap index. So it might only be interesting to add a small part of your portfolio as an add-on to participate more or less from the start phase of a company to its glamorous large cap phase. When analyzing other successful companies, such as Nvidia, we can clearly see its long way from being a small cap in the year 2000 until being a mid cap in 2015 and then finally being a large cap starting just 1 year later. So you had to wait nearly 16 years for being rewarded with the start of Nvidia's enormous rally we see today. And the next glamorous large cap might be AAR, which is on a good track since we all love to travel, and the trend to even longer and more interesting destinations is not just a hype. We might see a prosperous future for the aviation sector. We can see an uptrend from the past few years chasing one record to another, which might even increase since we just reached pre-pandemic levels. Additionally, flights nowadays take longer than 25 years ago due to ecological guidelines and efficiency. Airlines take the chance to make customers feel happier on board and sell the flight as an event instead of just traveling from A to B. The aviation fanbase has also grown steadily, which you can see by an increased aviation YouTuber scene. This fan community is then targeted by airlines with special flights. The fact that you can book not only the flight but also the desired combination of flight and aircraft, such as the A380, shows the enormous potential of the entire aviation industry. AAR is one of the best employer in the US market, which should not be underestimated when compared to Boeing's striking phase. AAR also plays an important role for government and defense, like the US military, with which it has many deals. But all this greatness comes for a price. a high PE ratio of currently 38. Compared to the Russell's PE ratio at around 18, it's comparatively an expensive stock. But due to its chances and great outlook, Barron's analysts still declare it as a buy. Especially its diversification within the aviation sector is one of its key strengths, additionally to a healthy work environment leading to loyal, important employees. It seems like a good alternative or extension to a classical aviation stock like Airbus and Boeing, or military stocks like Lockheed Martin. So the next time you're flying, the plane might be coming from a fresh maintenance service from AAR. If you find this video was insightful, please leave a like, comment or subscribe. This would help our channel to grow just like your portfolio. Thanks and see you in the next one.